It looks like we're starting to see a sell-off in the stock market and Wall Street that really began yesterday. We had weekly unemployment claims edge up yesterday, and then today we had the July jobs and unemployment report with the unemployment rate ticking up to 4.3%, triggering the recession rule, where the 3-month average of the unemployment rate is 50 basis points higher than the low over the last 12 months. So the recession rule is triggered. I was afraid that would happen, which is why I thought the Federal Reserve should have cut interest rates in the July meeting. Although at first I was initially happy with the Federal Reserve's dovish comments, pretty much teeing an interest rate cut for the September meeting. I was happy about that, but the markets are starting to think, based on the SOM rule being triggered, and then only 114,000 jobs added compared to 185,000 estimated, and average hourly earnings going down, that the Federal Reserve really should have been ahead of the game and cut interest rates in July. That's what investors are thinking, and I agree with that sentiment myself. I made a video a little over a week ago saying that I think the Federal Reserve should have cut interest rates in the July meeting, but I was willing to take what the Federal Reserve and Jerome Powell was saying about pretty much guaranteeing not guaranteeing, but teeing up a September rate cut if based on the data as of now. But it looks like markets aren't necessarily agreeing with that. We had pretty big sell-offs in Japan. We had the 10-year Treasury yield going below 4%, now about 3.86%, lower than where it started at the beginning of the year at 3.88%. Normally, markets have reacted well with falling bond yields, but now that's not the case anymore, because now markets are now worried more about slowing growth. I think the sell-off is slightly overreacted, in my opinion. We still had Q2 GDP that was really strong, and I think the productivity gains and tailwinds from technology and artificial intelligence will outweigh some of these new slowing growth concerns. Remember, it takes two slowing and declining quarters of GDP growth to define a recession. And we had a pretty strong Q2 GDP. So I don't think, look, the worst case scenario is that the market could sell off substantially until the September meeting. But with the Federal Reserve ultimately cutting rates then, and now markets are pricing in the probability of a 50 basis point cut, then I think the markets will stabilize. That's the worst case scenario. But the worst case scenario would be a short but quick sell-off, which that's the worst case scenario. Look, we had 2022 sell-off, which was slow and long. I don't think, but it didn't go down that too bad. I mean, the S&P 500 was down about 25-26%, NASDAQ about 35% and change. I don't think that's going to be the case now. If anything, I think this will be short and quick. And it's possible that this sell-off could be over too soon. And look, I'll have to admit, I think I was wrong. I said that the Russell 2000 stocks would rally after the Federal Reserve press conference. It doesn't seem like that's the case, because the markets are a little bit scared that the Federal Reserve is behind the curve. So I don't necessarily think that will happen right now. I was wrong. Look, maybe the data will show in the coming days I was right. But look, it looks like the markets are concerned that the Federal Reserve didn't cut. And the debate right now is not if the Fed will cut interest rates in September, but by how much. So we had good tech. Apple had good tech earnings last night. We had they beat on revenue and sales, despite, I think, slowing China numbers. So this shows that this AI super cycle for Apple with the iPhone 16 will catapult it further ahead. And then Amazon, they missed on their revenue, although their cloud growth was good at 19%. So Amazon stock is taking a beating, but Apple did well. And then I also want to touch a little bit on Wayfair. Wayfair reported earnings yesterday, and they made a big warning about the economy, pretty much saying that what they're seeing reminds them of the 2008 financial crisis in terms of demand. So I think that was another reason why the markets were down yesterday. And then yesterday, the markets were also a little bit spooked because they had ISM manufacturing numbers that came out pretty poor. And then the ISM jobs number came out very low, the lowest since pretty much COVID. And then before that, since the financial crisis and dot-com level. And then the data today in terms of 114,000 jobs and unemployment rate ticking up to 4.3%, pretty much further triggered those fears. So as I said, it's possible the market could sell off for the next few days to weeks, but it's also possible the bottom could be in soon. Obviously, we have to see. But I ultimately think that the economy is still strong. And if there is a sell-off, I don't think it'll necessarily last long, because I'm still pretty optimistic about the tailwinds for economic growth from AI and artificial intelligence and the earnings growth we've seen, at least for the most part, at least so far. So let's stay tuned and see what happens for the rest of the day.